All right, let's talk Creative Realities, ticker CRI. They just dropped their second quarter results, and wow, the market's reaction was something else. Today, we're going to break down exactly what happened, why that stock surged, and what it all means for the next few quarters. Okay, so here's how we're going to break this down. First, we'll hit the headline numbers. Then, we'll get into the turnaround story that management is really trying to sell. After that, we'll look at what's on the horizon, the potential catalysts for growth. And finally, I'll give you our pitch for what to expect on the next earnings call.
All right, first up, let's get into the numbers that really lit a fire under the stock and got everybody's attention.
So top-line revenue came in at $13.03 million. Now that's pretty much flat compared to last year, but here's the key. It beat analyst expectations by a solid 6%. So right off the bat, a nice beat.
But honestly, the top line wasn't even the biggest news. The real story here was on the bottom line. Creative Realities reported a profit of 1 cent per share. You might think, 1 cent, who cares? Well, Wall Street cared, because they were expecting a 7-cent loss. That 8-cent swing is what really turned heads.
And the market? Oh, the market absolutely loved this. Investors just piled in, sending the stock soaring more than 14% in a single day. A huge move.
So, that's the big question, right? With revenue basically flat year over year, what on earth did investors see in this report that made them so bullish? What sparked that kind of confidence?
Okay, this is where it gets really interesting, because this quarter was a tale of two completely different stories. On the one hand, you've got this much stronger balance sheet. The company actually generated cash from its operations and used it to pay down over $3 million in debt. That's fantastic. But on the flip side, their gross margins took a serious nosedive. So what gives?
And this table kind of lays it all out for us. You can see that flat revenue and the little dip in adjusted EBITDA, but look at that ARR run rate. That's annual recurring revenue. That is the golden goose for a company like this, the high-quality, sticky, predictable revenue. And it's up quarter over quarter to $18.1 million. That's a very healthy sign.
Let's move on to section 2, because this all feeds into the turnaround story management is pitching. And it's focused on two things: killing that debt and getting those margins back up.
So about those ugly margins. Here's the explanation for management, and it actually makes a lot of sense. It wasn't because they were messing up or losing pricing power. It was a temporary thing, a mix shift. Basically, their customers got spooked about potential tariffs and rushed to buy a bunch of lower-margin hardware up front. So the company pulled forward those sales, which just kind of skewed the numbers for this one quarter.
And they didn't just make excuses, they laid out a roadmap for how they're getting back on track. It's a pretty straightforward 3-step plan. First, let that product mix get back to normal. Second, scale up the new deployments, which bring in the good, high-margin revenue. And third, just keep a tight grip on costs. Simple, but effective.
And you can really hear the confidence in this quote from the CEO, Rick Mills. He's not just talking about a one-time thing. He's signaling a renewed focus on using their cash flow to deleverage. This is exactly the kind of disciplined message that gives investors a lot of comfort.
All right, so that's the story of Q2. Now, let's look forward. Let's talk about Section 3, the catalysts. What's coming down the pipe that could really fuel some growth?
And believe me, the pipeline looks pretty stacked. We're talking about a major pilot with a big quick service restaurant chain, over 1,000 locations. They're testing their AdLogic media platform. They've got proofs of concept with huge convenience store brands like Circle K and 7-Eleven. And then there's this really important security certification.
Now that big QSR pilot is one to watch. Yeah, it got held up a bit by some on-site construction delays, things that were out of their control, but management says they've got a clear line of sight now and they expect installations to really ramp up in the second half of the year. And remember, those installations bring the good stuff, high-margin service and software revenue. And don't sleep on that security certification. This SOC 2 Type 2 thing, it's a huge deal. It's basically a stamp of approval from a rigorous audit that tells big enterprise clients, hey, you can trust us with your data. This opens up a whole new level of contracts for them, the kind of deals their smaller competitors can't even bid on. It's a major competitive advantage.
Okay, so we've covered the past, we've looked at the future catalysts. Now for our final section, the next call. This is our take, our thesis on what comes next for the company. So, after that huge 14% pop, this is the question on every investor's mind, right? Where does the stock go from here? Was that a one-and-done pop? Or is there more fuel in the tank?
All right, here's our forecast, our pitch for the next earnings call. We think revenue is going to tick up sequentially, somewhere between 13.5 and 14 million as those QSR installs start to kick in. We also think they'll stay profitable on an adjusted basis, probably a penny or two, as that revenue mix improves. And for the stock price, we're forecasting modest upside. The market's probably going to be in show-me mode, waiting for proof that they can keep executing.
So that brings us to our official rating, market perform. And look, here's the thinking. You've got some really promising catalysts and a disciplined management team, which is great, but you can't ignore the execution risk and the debt that's still on the books. It's a balanced picture, and market perform reflects that.
And finally, as always, we have to state this very clearly. This is not financial advice.